And obviously, as always, ask questions as we go. It's going to get a little nitty gritty today. And I'm happy to take this wherever we want. I don't have, like always, it's more of a conversation in these webinars, to be honest with you, but we will, we'll do some price actiony sort of rehash things, and then maybe we can go look at the market a little bit. It was back in November. I just wanted to talk about something, Swats, at the top of my head. Given the stock market action over the last week, I'm sure that everybody's talking about and thinking about it, etc. Back in October, November, I told some of my clients that we should start building shorts the second week. Well, I mean, I've been short since last year, but in terms of when I expected things to roll over, and this is, I'm mentioning this just because it's a good lesson in general. The market is full of psychology. So I've mentioned time of day before. So if you are, there's time of day, there's time of month, and then there's time of year. All right. Now, let's say that, and I mentioned this like I said, to my people in like October. I said, watch for the third week of January for the market to start rolling over. And the reason why I said that, and then as it turns out, it was the fourth week. But the reason why I said the third week is there was no sign of it going down necessarily to begin the year. If you remember 2016, the market dropped right at the new year for about 3 weeks. And then it shot up after that. All right. And a lot of this is just the psychology of where you are for the time of year. So let's say that you are managing money and the market rallied 10% in the first 3 weeks of 2018. 10%. All right. And 40% in the last 12 months. So if let's say that you had redemptions, etc., and you just rounded all your money up and you reinvested, and within 3 weeks you up 10%. All right, that's very significant. A lot of funds, that's their performance for the year. All right. I think I was reading a Deutsche Bank article, and they were talking about on the currency side that the world's top currency fund managers managing 50 million a year, if you can make 1.5% a month, you're in the top 1% of those. And I know a lot of you are thinking, percent, like this is Forex, I can make 2% in half a morning, right? Well, the risk profile is a little bit different. My point being is this: Bernie Madoff, all right, and I'm not advocating firing up a big fat Ponzi scheme, but he averaged 10 to 12% a year, all right, and was just, I don't know if you've seen the movie, you should, it's good. And my point being is that if you can go to percent a month, you're killing it, all right. And he was turning down hundreds of millions of dollars, and all he was doing was robbing Peter to pay Paul, all right. And because he was averaging 10% a year, percent a month ish, he had so much money he didn't know what to do with it. And the only reason he got caught was because of other funds that his clients were involved in tanked, and those clients needed redemptions from him to offset those other losses on margin calls. That's the only reason he got caught. Otherwise, he'd probably still be bossing around in his private jets and his G6s, right? So the psychology is, hey, we're up 10% year to date. All right. If you're up 10% in 3 weeks, what are you going to do for the rest of the 49 weeks? All right. There's a lot of, so my thing is that there's going to be some profit taking, and then obviously Powell came in and we started getting noise about 50 basis points, etc. But nothing's fundamentally changed. My point was it's just psychology, and then the algos kick in and blah, 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 and it becomes a self-fulfilling prophecy. All right, but in terms of the psychology, it's important to think about these sorts of things. Where are you at the end of the day? Where are you at the end of the year? Where are you at the end of the month? And a lot of times the market will change direction just because of the fact that you've had two massive up days or two massive down days. Why did the stock market rally on Tuesday? Well, because it gone down London, gone down New York, gone down and sitting on support in Asia. The New York guys are unlikely to sell it again. They've had their day in the sun. Anyway, I just wanted to mention that never underestimate the psychology of time. Okay? And, kind of try to walk a mile in other people's shoes. It can help. The other thing too is this, and this isn't an exact science, but it's just another thing, another thing to keep in mind. Where is this chart? Here, we'll use this. Okay, so this is just a shiny thing. These are just EMAs that are 5 deviations apart, so 5, 10, 15, 20, up to 100. Okay, and it's just a thing that I use to determine, overall trend. The angle and separation of these is important, etc. Now, this is something that I was paying attention to, is this distance here. This is the 2008 crash. And why do we look at, David, we currency traders, why do we look at the stock market? Well, because it's important to the yens, it's important to dollar correlations. Maybe you trade it directly. It just, from a correlation standpoint, it matters, right? It matters to the commodities. If you're going to have dollar strength, you're going to have a big commodity drop off. That means you're probably going to have more commodity weakness, and you're going to have commodity currency weakness. So that means you probably don't want to get short things like Euro, Aussie, etc. Right? So stock market stuff is a spill on. Although the stock market is way smaller than the currency market, it is still the tail that wags the dog. So looking at the equity markets is as important as anything else, right? And I haven't talked anything about price action yet, but I just wanted to mention these things that you can use in your trading in other areas too. All right, while it's on the top of my head, these are valuable lessons. So this was the 2008 crash here. Okay, and admittedly, I wasn't counting any of the, I was just looking at, like, this is the 5 EMA and the 10 there. Right, this distance from the peak of this to that first moving average is almost identical within a handful of points. And a lot of times you're going to get bigger separations from bigger distance separation from this moving average. Just a monthly chart, by the way. On the downside, just because of fear, right? The downside always goes much quicker and you get this steeper drop off, and as a result, you get bigger separation. But this was on the bullish side, and we were in an identical stretch out that we were here in 2008. I just thought that was interesting and something that I was watching, and it kind of added to the pie. And then we got that very strong non-farm payroll. The thing I did want to mention on the fundamental side, sorry, I'm all over the show this morning, is we saw some wage inflation on Friday, but if you look deeper into the numbers, there was no wage inflation in unsupervised manufacturing jobs, which is a huge component of non-farm payrolls. So a lot of that wage inflation was more on food and beverage side, which is where America's been creating a ton of their jobs. Like the last 10 non-farm payrolls, it's been creating like 30,000 food and beverage jobs. I mean, it's really, we like to eat in this country a lot. And yeah, if when in doubt, open a restaurant. So my point is that the wage inflation was not really where you want to see it. The components were a little iffy there, although it was a much stronger number than we've seen. And that's been the big thing, right? Is that the stagflationary thing of, yes, we're creating jobs, but there's no wage inflation problem. Okay, anyway. All right, so let's talk about price action. And those of you that have follow me for a while, or Jeremy, he's been around, Adam, they've been around forever. You guys have seen this a million times, and it's still something that is part and parcel of the package here. If you can, even if you are a spot trader, and I'm talking like you wake up in the morning, you try to make 10 pips, or you try to make 20 pips, and you're trading on a 5-minute, 15, whatever. I still maintain that you want to know what's going on the bigger picture. Okay? And I think that's something that's underestimated is this. Let's say that you are, I don't know, let's say that you're into AMG Mercedes. Okay? And you know a C63 costs $80,000. And it gets towards the end of the year and the new model is coming in, and you see it in the dealer for 62 grand. Okay, brand new, 62 grand, forget about depreciation. All right, is that a better deal than the 80 grand car that you want to own? You've decided that this is your car, you want to own it. Of course, it's a massively better deal. All right, and sometimes I think that trading should be treated like that, as in, is it cheap or is it expensive? All right. Too much is boiled down to, oh my goodness, I'm going to risk 13 pips. All right. The big question is ultimately, is it cheap or is it expensive? Okay. And I think that should be one of the core questions we're asking ourselves. All right. Now, if the other thing with any price action is, and I've used the analogy before and it's a lame one, the difference between weather and climate, people say, oh, it's been a hot summer, but you might be in a cooling phase of the climate. So you can have different weather, which is price action, within the longer term trend, which we'll call climate. Okay. And price action is no different in that you can have a massive up move on the short term, but be in a weekly downtrend. Okay, so what does trend mean for us? If you are, I'm more of a contrarian trader because it's more psychology, because I find that in a trend, price never looks cheap. Does it make sense to you? So often we hear, I want to trade with the trend. And it's great advice if you're in at the bottom. But if this is the trend, which we've seen a lot of lately, where is it cheap here? It never feels that way, does it? And as a result, you kind of just sit on the side. And then even when you win stuff, you feel a little vulnerable because you're never at a point where it's cheap. Okay. So let's say that price is defined, a uptrend is defined by a series of higher lows and higher highs. All right. And we'll call this, I don't know, a weekly. And let's say that it's, prices come down previously and done something like this. And then we have had a little fundamental switch and it's kind of cruised up a little bit. And we're running into this cluster of price here. What is likely to happen at this area? Is it likely to just push right through here at speed? No, it's likely that we going to do a little lower high and then push down to a support level of the uptrend, at which point you don't really know. Okay, but my point to this is that this trade here is very predictable and very easier. Okay, so if you have a known area of weekly resistance or monthly resistance or daily resistance in an uptrend, and then you start to see something like this develop on a 4 hour. All right, so we're gonna use this essentially as our 4 hour microcosm. In other words, we're gonna zoom into that zone. And all of a sudden you start to see this sort of thing develop on a 4 hour. Okay. And it pushes down and nudges below these. All right. It's likely that it's going to almost push up and maybe even make a higher high. Okay. Or it's going to kind of stop here. But likely it's going to make a higher. Why? Because you've reached a buy zone of this rise. So people are going to buy it. However, you're at the weekly resistance here. So in other words, is it sustainably going to run through the roof? Unlikely. And you've had a breach of the last lower low. Okay, I've probably lost some people because we're getting highly technical. But what I'm trying to demonstrate is the use of the longer term time frame relative to the shorter term price action. Does that make some sense? Because this way, it's doing two things for you. One, the weekly is showing you an anticipated area of resistance. It's been there forever. Okay. And two, it's not goading you into trying to buy it through that area. Okay, then you can look at things like an hourly chart up top here and try to get short looking for this trade. And are you counter trend trading on an hourly and a 4 hour? Yes. But you are trading with the trend on arguably, say, a monthly or weekly basis. Okay, I'll give you another example. Let's look at euro dollar right now. Guys, if I've lost you, please shout, because these are critically important components to what you're doing in your trading. Like, very important. And if you can master this, it'll set you, it really is a, and I hope I'm not being ambiguous in the lesson here. We're going to go over a few examples, and I think hopefully it starts to make some sense. Let's do this. Okay. So this is euro. Okay, monthly. Let's look at some basics here. We can pop in a little, we can take the support to or the resistance any way you want. It definitely is a zone on the euro because of this. The other thing to think about is the fundamentals here a little bit, that Draghi has made it very clear that the Eurozone is improving quicker than expected. It's really not a surprise. But it won't be able to stand up on its own 2 feet just yet. All right, so what are the pieces of information that we know? All right, let's pop in a trend line here. Oops, that's not what I want. Okay, and we'll scoot across a fraction. All right, and we got the stuff here. Yeah, it does. Euro's been a little bit of a powerhouse lately. So is the pound, for that matter. I mean, that's really just a little bit of a switch in the dollar fundamental. If you remember when we were in the early 120s on the pound. I was just beating the door down to get long that. And the Euros arguably outperformed it just a fraction, I guess. Not by a lot. Let's mute this telephone. Anyway, so what do we know here? Let's grab a fib of the whole thing. And it's bouncing off a little 382. But this whole area, in my mind, is kind of a resistance zone. Okay, and if you look at the dollar index, it's very similar. I won't take you to it, but it's basically the inverse. Okay, now what do we know? We know that arguably we have a new little uptrend. Little series of high lows and high highs. So is it likely that we're going to do something like this? Go visit parity? I don't know. I'm not afraid to say I don't know. Okay, but what can we ascertain here? Okay, let's go to a weekly. And if we zoom out a fraction, where is the immediate support? We don't want to get too support heavy because the amount of resistance here, it's very likely that we're going to get a larger pullback, I would think. Okay, now that's because of the newly formed uptrend. It's very unlikely that that just goes, thanks, let's go down there in one fell swoop. All right, which actually creates a few opportunities. So even if you're a spot trader on a daily basis, you should be doing this analysis. Because just trading on your 15-minute and 5-minute, you're going to get blindsided left and right. And, it's like, if, for example, let's say Euro does this and jogs up here, and all of a sudden you open the market and you see yourself at a weekly central and whatever else, you're like, oh yeah, I'm going to get long. And it makes a lower high and just falls on its face for 250 pips. Why'd that happen? Like, everything was saying long. No, you were running into the buzzsaw on a weekly. Okay, so the fact that it's developed this uptrend here by virtue of making a series of higher lows and higher highs means that you're going to have a ton of buyers waiting for you here at 121. Okay, and it's likely that we do also zooming out, that was the bottom of these candles. Okay, so it's very likely that we see something like this develop. Here's a daily. It's admittedly broken this lower low, but it is a high low with respect to this one. Okay, it's coming off a weekly S2 at 2250. So you're probably looking at least 2350, which is the bottom of this little swing low. Okay, and if we grab a fib of this high, how many of you boil it down? Like, I would love to know, like, how many. You got to look at all the things. I think it's easy as when you're trading by yourself to just get neglectful and little casual. You got to look at all the things. All right, so I think it's very likely that we do sort of something like this. Cruise on up here, even towards 124. Okay. Poke a little. And then make one more jog down before doing that 27 area. Okay, now why would I expect this little drop? Well, because you've come off some resistance, the dollar index has come off a lot of support. And you have made a little change of direction there, and you've broken the swing low. So it's likely you get one little pullback and extension, but that then will take you to the known support. I'm doing this a little shy because of the speed of the uptrend, and I'm sure some people are watching stuff like this. And I just, the speed of the uptrend tells me that it's probably gonna, 2160 will probably be about the spot. We're gonna have to see how it develops next week. So, I could absolutely see something like this developing into the 27, 26 and a half, 50, 27, and then we start to see a drop back towards 113. That's a long way. Like 12 to 1300 pips. Okay, so what is that ultimately going to look like on the 4-hour? Here's a 4-hour chart. Making a series of lower lows and lower highs. Come into this cluster of support. It's bouncing, no surprise. Where's the next significant level of price action? Yeah. Okay, so how about sort of something that looks like this? And then you start to get this kind of thing. You break that low, you retest the high, you collect all this stuff, and then you make the slow sort of drop to 2160. But the major component is not this 4-hour. This is what I'm trying to say. The major component is not this price action. The major component is the weekly and the monthly. Yes, it is. Okay, and then you're just interpreting this on the slightly shorter term time frame, and at the bottom here, because we know we're running into the weekly support, what could we anticipate there? We could anticipate something like this. It's not what I want. Let's say we do something like this. And it pushes down, blah, blah, blah. And all of a sudden we start to see this kind of thing develop. I think it's, at that point, quite easy to get yourself long for at least a return back to 124, if not 127. Yeah, and that's Carlos, that's just a tough one because I don't know, I don't know. I'm with you on that. I'm like, I could absolutely see it going there. My grand plan on this was to try and start buying euro below 108 and trying to take it up towards 140, 135. And at the same token, on the pound, trying to get long below 127 for 160. I think the Fed's going to drag the heels. I think the rest of the world's going to catch up a little bit. I think the Aussie is going to lag. Obviously there's a ton of trading around that information. A ton of trading around that information. But, euro to parity, I don't know. It's one of those, I just don't, I don't have, I don't have a clear mindset on that. And typically I have a pretty good idea as to what I want to achieve. But, anything below sort of 108, 107, and I consider that, my thing is, I like to ask myself the question, the 24-month question. If you were staring at, say, the pound dollar, for instance, at 125, okay, irrespective of the news cycle at the time, if you were looking at pound dollar at 125, and somebody said to you, do you think in 24 months the pound will be close to 150 or 110? What would you say? I'd probably say I prefer it around 150, I would think. And I am with Jeremy. I am very concerned for the long-term viability of the dollar. Very concerned. And a lot of that concern is because of the complacency of America to the dollar. They've had it too good for too long. Just raise the debt ceiling wherever you want. It's fine. No big deal. And if you look historically at reserve currencies of the world and the duration that the reserve currencies, exactly. And I don't want to get political because we're in a price action, price action webinar. But blockchain technology aside, the cryptos are the flavor of the month because they're great anti-dollar trade. And in my mind, the only reason why we went into Iraq as a nation was because Saddam decided that it would be a good idea to start accepting euro for oil. And we said to ourselves, ooh, that's not a precedent we want. Because what's the easiest way, if you, the reserve currency, the easiest way to pay down debt is just to devalue your currency. So then you pay it back in less dollars. Exactly. Greece was the laughing stock. Why? Because they couldn't cover their debt. Only America covers their debt by printing money. Like Greece actually had to come up with some money. And if you take the United States' ability to cover things by making money, what is, and I think that admittedly, the cancer hasn't spread so prolifically because everybody's been doing it. So you look less bad. You're like the top bully of the class, but because the other kids are beating each other up too, you get a little bit of a break. You don't look quite as bad because everybody's in trouble. But I just feel like people are going to want to, if we weaken our currency so much that there's going to be big noise around a basket of currencies. The China, North Korea, Iran, Russia, they're starting to become big economic powerhouses. And, there's big talk about them forming their own currency, cryptocurrency, fiat currency, to do business between themselves. And that's huge. And that's why, in large, a lot of the Asian countries have been trying to not outlaw, Japan notwithstanding, but a lot of them have been trying to mitigate the effect of cryptos because they can't control it and they want to form their own, particularly Russia, China, and Iran. None of that is good news for the dollar on a very long-term basis. That said, I do expect 1,000 pip drop on the euro and 1,000 pip drop on the pound not this month, not next month, but I do expect it to start sometime around April, May. So something to think about. And I hope I didn't get too political there. I didn't really mean to. But these are all components. These are all components to the plight of the dollar, I feel, and the destruction of dollar confidence. Right. Let's we got 6 minutes. Let's try to draw back to this price action side of things. All right. So are there any questions about, do you guys want to look at something else just for another illustration of this? All right, let's look at the stock market very quickly. How's that sound? So I drew up a couple of charts yesterday, doing some analysis for a friend who's managing his wife's retirement money, which is just a terrible idea. Fastest way to divorce. Manage your significant other's money. Bet you guys didn't think you were going to get marital advice here too. So this is a Dow chart here. Let me pull that up. Okay. And that's a joke, BTW. So here's a monthly. And I've been watching this little channel for a while. And if you measure this channel width and then take that projection up, the width of this is almost identical to where that Dow Jones flipped its lid. All right, now, if we take a fib of this last swing, you've come off flush at 382. If you take it right down to that little last swing there, you've come flush off at 382. Oopsie, we'll scoot this up a fraction. Sorry, that flush off at 382. Now, I think that we want to probably retest the top of that channel. Okay, and that would make some sense when you look at this daily, just because, you know, of how significant this drop is. It's arguably a little swing. You've broken these last two swings. It's very likely that, you know, you get sort of something like this going on, you know, and then, you know, something like that. The sound effects are part and parcel of the analysis. Okay, and I think, you know, you get this consolidation fight up here, and you get this little higher low as people start, you know, because the bulls are going to see this as a higher low of support and be like, oh yeah, I'm in there. And I just think it wants to scoot down that one more level, which isn't catastrophic relative to the bottom. I mean, you're talking a marginal lower low. Okay. So on the 4 hour, you'd like to see this sort of cycle down on the stochastic and then cycle up. And going back to the daily, this stochastic will then probably do something like this. I don't consider this a bullish cross, by the way. I expect it to do this. It crosses back down and then loops back up. And at the same token, if you look at the weekly, you'll get sort of something like this on the weekly. Seen that a bunch of times, haven't you? Very similar to this. Okay. Oscillators are laggers. You've got to anticipate how they're going to look. It's bizarre. But I think this is what separates a good technician to something half-baked. All right, so, if we look at the 4-hour, kind of something like this, it picks up this support, cruises up, and then, we muddle around here for a long time, probably 2-3 days, and we start one more little drop. Okay, and it's a similar analysis. It's a similar analysis on it's a similar analysis on the S&Ps, right? Here's a VIX chart, and we can do an entire lesson on this. Bear in mind that 9 and change area meant something here. Another reason why the stock market did what it did. I mean, these things aren't that hard. I mean, the evidence. This was your .com towards the tail of the .com. This was the housing market. That's a house. It's a door. Okay, and now we had, equity market stuff. But it's in, we haven't lived above this 20 handle, which is kind of the bull and bear divider on the VIX. We've got to find that as support, I think, to change things. We haven't done that. In other words, I don't think the bull run's over. But it is interesting. This takes a long time from the time it bottoms out to the time it actually starts to crash. It takes a good 12 months. Keep that in your mind. I just touched my head, you guys. I want to show you this, though, and I know I'm jumping all over the place. I wish we had a little more time today because there's a lot going on. Okay, this is SPY, which is just the S&P 500, the S&P 500 ETF. So if you want to get delevered in the stock market, this is probably your play here, right? I think it's very likely that we do a little fib of this drop. But then I think that, this 21 is likely to come up a bit. But then I think that we want to ride the inside of this channel again. Okay, so in that respect, we'll go to weekly. So in that respect, sort of something that looks like this. And then and then it kind of just creates a sort of very, very messy kind of drive back to the upside after finding a little bit of a drop below that. And I had 25.20 in mind. I'll get to that. So I'm not reading. FX Street, if I go over by 5 minutes today, is that all right? I'll read it in just a sec, Carlos. I appreciate the feedback. So S&Ps in the same regard. I don't quite have that trend line. I'm sure that some people have this drawn. Oh, my rodent, I think, is running out of batteries. I'm sure they have something like this drawn, which is very similar to that SPY. And as a result, I think it's a little messier. That's why I used the SPY. I just felt it was a fraction cleaner. Uh-oh. Grab a fib here, the last major swing. We can take it here as a 382. We can take it all the way down to the bottom here, which I think is a fraction more obvious. And that's calling for 25. So I thought that we could sort of step down to that 25 and then make this very ugly kind of grind back to the upside before we do this. Okay, and this is probably 8 to 12 months. So what does that mean for us as currency traders? This little grind up is probably a good yen carry. And maybe that takes the pound in towards the early 160s, and then it drops 2,000 pips. So good trading this year is what I'm trying to say. Like really good trading. I see a lot of great things for us. It's a good time to be a currency trader. Last year, iffy. This year, I think it's on both sides. Let me read this real quick. I agree with you, and we can talk. We haven't had a trader psychology webinar. I mean, I only do one webinar a month here. We haven't had a good trader psychology webinar in a long time. And that's what I mentioned right up front, is that for me, the biggest quantum shift in my trader psychology has simply been asking myself, is it, and I know it sounds rudimentary and silly and juvenile, but literally, is it on sale or isn't it? And if I can live with saying I bought something cheap or I sold it expensive, it makes it a lot easier to justify staying in something, living with the pain. Even if you're early, and I'm notoriously early. I mean, on my fundamental stuff, I am notoriously 3 to 5 months early. And it can get really tiresome and hurt. But eventually once gets paid and you forget about the pain. But the bottom line is, if you can justify to yourself, hey, I bought it cheap, it's a good deal, I feel like you can go a lot further. And it's not a big thing. It's just, a change in mindset. And maybe it's just getting older. I feel like, as a younger man and as a younger trader, I was more concerned about the nitty gritty. Now it's all a bit of a wash to me. Guys, I hope you learned something. I was all over the map today. And if you want to continue the discussion, remember, I got nothing to sell you. I got nothing to market. I make my money trading. If you want to talk about some stuff, at Forex David on the twit, FOREX David. Or you can email me, c5davidpegler@yahoo.com. C5 as in the letter C5, the number, David Pegler at Yahoo. Happy to answer any questions you have. All right. Thanks, everybody. And we will see you on the next go around. Thanks, FX Street.